All right. Hello, everyone. Can you hear me clearly? If you can hear me clearly, that is great. Now, what I want us to look at today is a simple top-down analysis model that enables you to get good entries on trading. All right. A top-down analysis model that enables you to catch good entries on your trading. Now, for myself, I trade major currency pairs. I trade pairs that has the USD as a quote currency. You know, any pair that has something like this, XSX USD, anything like this XSS being the base currency, it could be Euro USD, GBP USD, AUD USD, NZD USD, whatever that has USD as a quote currency. I'm interested in it because it's mostly a major pair and it's volatile enough to move. It moves very well, so you can get good opportunities in such pairs. And if you trade any of such pairs, in your analysis, the first pair you want to be analyzing is the dollar index, which is this DXY. The first asset you want to be analyzing is the dollar index. And during the weekends, if I want to do my weekly analysis for the new week, I start my analysis from the weekly. At the end of the week, before we get into the new week, I get to start my analysis from the weekly. But for day trading, when it comes to day trading within the week, for instance, today is okay, we've already gotten into Tuesday Nigerian time, but I was getting ready to do this around Monday. So we finished trading on Monday. This is Tuesday, midnight Tuesday. So if I want to see the market, I start from the daily time frame to do my top down analysis, TDA. All right. So the first asset I analyze as a trader that trades pairs that has USD as its um, quote currency, I tend to know what the USD is actually doing. That is the dollar index. So I see the direction of the dollar index. It gives me an insight into how the other assets I'm going to trade will go. Because if the dollar index is bullish, other assets that work with dollar index as its quote currency will most likely be bearish. All right, they are negatively correlated. Negatively correlated, not exactly, not 100%, but to some degree, to an extent, they are negatively correlated. So if dollar index is bullish, all the XXX USD pairs will most likely be bearish. All right. So that is how it works. Euro USD, GBP USD, NZD USD, AUD USD, all of that will most likely be bearish. So if I come to the daily, I want to see what the market is currently doing, where it's reacting from, where it's heading to. The two things I want to see on the daily is where's market reacting from and where is it heading to. Reacting from, sorry, let me get that spelling correctly. Reacting from, heading to. Where is market reacting from? Where is market heading to? These are the two questions I want to ask myself when I come to the dollar index. Now, we could see that dollar index. And another thing for structure, I don't tend to, because structure is dynamic. What do I mean by dynamic? You see structure anyhow you want to see structure. All right. There's so much leg. There's so much going on market structure. Some people get to mark their structure from as far back as years back. I don't mark my structures years back. I just tend to look at the immediate structure the market is giving me on the daily because I am an intraday trader. I am a dynamic trader. There are days I do swing trading. There are days I do intraday trading. There are days I do, you know, scalping, just get in and get out of the market. Whatever opportunity the market presents itself, presents that is suitable for me, that meets all my criteria, I get to execute it. All right. So I'm a dynamic trader, but mostly I take intraday trades. So I tend to look for my opportunities on the daily time frame. I look for my opportunities on the daily time frame, opportunities that will take me to the next high or to the next low. So we are here on the daily time frame. What do we want to see? The most immediate reaction of what price is doing. We can clearly see this is DXY, so dollar index. On the daily time frame, we can see this. We can see that this was a sweep. This was a liquidity sweep. Market swept this low and then reacted to break above this high, which was the last high it created when it did this. So this was a sweep. Came back up here, did something we call failure swing, and then took this high here, which is a break of structure. All right, when it took that high there, which was a break of structure, it went up, created a new high, came down to mitigate a valid demand zone. This is a valid demand zone here. All right, go through my other videos. I think I've done a video on how to validate your zones. How to validate your zones. But if you are not so clear on how to validate your zone, I'll quickly run through it. There are three things that validates a zone. Okay, three things that validates a zone. The first and most foremost is that that zone breaks structure. Okay, that zone breaks structure. That's number one. The zone must break structure. This is it. This is the zone. This was the zone that took this structure here. It broke the structure, this momentum. Even though it did a sweep, came back, it finally broke it. Number two, the zone must have inefficiency, that is imbalance. If you look here, you will see this massive imbalance here. This massive imbalance here. You see that imbalance? You see it? All this. This was an imbalance, all right? Or as some people call it, fair value gap. So you see that gap there, that imbalance there. Zone must break structure, the zone must have imbalance. And then number three, the zone must have liquidity. It must have liquidity, either inducement liquidity, structural liquidity, engineered liquidity. It must have either one of this. The zone must have liquidity. Engineered liquidity, structural liquidity, inducement liquidity, whatever you want to call it, the zone must have it. And in this case, our zone has it from this place to this. All these are liquidity, right? All this price action, everything price was doing here, all this pullback price was doing here. They were liquidity until price finally mitigated our zone. So these are the three most important criteria a valid zone must have. And then number four, which is as important as the other three, is that for demand levels, demand levels must be at the discount of the range. Demand levels, a valid demand level must be at the discount of that immediate trading range. Now, when you look at this trading range from this low right here, from this low right here to the high, which was this high it created, you could see that I divided my Fibonacci tool into four equal parts. Each part is a quadrant, into four parts. Each part is a quarter, rather, is a quarter to four quarters. Okay, so 0.5%, anything above 0.5% is regarded as premium of that range. Right? Anything below 0.5%, which is a 50% mark, is regarded as discount of that range. So when you mark your range to have a valid demand level, a valid demand zone must be below the 50% of the range, which is below the 0.5 of the range. All right. So when you are selling, it's vice versa. The supply zone must be above the 50% of the range. But here we're talking about buying. So this zone meets all the criteria. That is exactly what validates this zone. All right, that is exactly what validates this zone. And for me, dividing my zone, my Fibonacci, my Fib tool into four quarters, I want to focus more. I prioritize extreme zones. The first quarter, I call it the premium. Extreme premium. The quarter following it just before the 50% is premium. So anything above 50% is premium, of course. So here is premium, here is extreme premium. So I prioritize the extreme zones. Here is discount, here is extreme discount. Like I said, I prioritize the extreme zones. Why I did not trade from this extreme zone is that there is no inefficiency. All market inefficiency has been rebalanced. There's no imbalance. Okay. This is an efficient price action. There was an inefficiency here that took price up here, but you could see that it was filled. Market came back, filled that inefficiency, and then created the one it created here before it rallied up. So all these things I just said now, five of them, break structure, number one. Number two has imbalance. Number three has liquidity. Number four is at the discount level of your FIB tool, is at the discount of the range. And number five has no other inefficiency beyond it. Okay, you must trade from the farthest zone. If Because in some price action, in some ranges, you will see multiple zones. All right. So trade the zone that meets all these criteria. So right now there's no other inefficiency here. This zone meets all the criteria. Sorry, I had to just go into that to help newbies and all of that. So that validates that validates this zone for us. Okay, that validates this zone for us. Now that we have validated the zone, the next thing we want to do is we want to just take our entry from that zone and target the next high. Which if you actually do that, you'll see that the zone actually played out, and your stop loss could be just under that zone. And this thing played out from when to when? Let's see, April of 17th to June of 18th June. So about some months. So basically, the daily time frame is to give us our trading bias. Once we have a settings like this, once we have something like this, for that full period, you just be looking for buy trades, buy trades, buy trade. You could see that this is how you get your directional bias for people that want to get their directional bias. You could see this is a valid setup. So this is on DXY. Of course, DXY is just to correlate to your other pairs you trade. Okay, you're not trading DXY, but you just want to use it to correlate other pairs you trade. Now you can see from 17th April to 18th June, we just knew that, okay, for this period of time, we are bullish till this high is taken. We are bullish, and this is the daily time frame. Is a very solid. It's reacting from a solid zone, so it has a high probability of holding. Anything we are doing in the market is probability based. Everything is probabilistic. You could see that market did all of this, came back, mitigated the zone again, and then finally gave us take profit. All right. So anything you are doing here is just for you to frame your bias, bullish trades up until take profit. So that was how we got this entry. So we started again, and then we took that high. Now, if you look carefully, you see that we have two zones here. We have two zones here. All right. We have two zones here. We have this zone and we have this zone. We are still bullish on the XY. And I'll tell you, we are bullish till this place because this is the next supply. This is the next supply I can see from this zone because all other zones are efficient. So all this supply had failed to hold. So we are targeting this next supply here on the daily, right? So I'm bullish till that's high. I'm bullish till this zone. As if price mitigates this supply, we can start looking for sales. And remember, this is a daily time frame. So for now, I have this zone and this zone. I'm hoping price will come back to. So if I should mark my Fibonacci, you could see that The first zone is actually just on that 50%. So it's on discount. If price clears this 50% mark and comes into discount, we can take it with a confirmation. If you get a good confirmation on this zone, that means this zone will be ignored to be used later in the future. Okay, you can trade from here. But my priority, the one I'm going to prioritize, the one I'll prefer is if price does a deeper pullback to this zone before we continue up. But you know, this is the daily time frame, so it takes its time. Price takes its time. Price might come here, give us some reaction, which if you go to the lower time frame, you can see some quality trades before it finally mitigates the zone and then probably will continue high. Take note, price can ignore a zone and move on. All right, price can ignore a zone and move on without having to, come back to your zone or anything. You can see there. I can show you some examples. Price can actually ignore a zone and leave it hanging till whenever it feels like it wants to come to that zone. I don't want to go into all of that right now, but just take note. Just know that price can ignore a zone and just leave it hanging till whenever. All right. So we have these two zones. We're going to see how it plays out. Now, when you come to these two zones, because of what you're saying, we're expecting that this will be the current high. We're expecting that price should come down. Price should sell. We're expecting that price should sell. There are two moves the market always makes. There's what we call in a bullish trend. This is the impulse move. The pullback is the corrective move. Another impulse move. Another corrective move. Another impulse move. So this movement, this price action you're seeing here is impulse, corrective, impulse, corrective, impulse. All right, this is the pro trend move. This is the counter trend move. Pro trend, counter trend, pro trend. So some people trade corrective moves, that is pullbacks to demand to valid zones. Some people trade expansion moves. We have expansion and correction, expansion, correction, whatever I want to call it. Some people call it swing and pullbacks. However, I want to say it, just know that price always moves in impulse correction, impulse correction, impulse correction, or what we call expansion retracement, expansion retracement, expansion retracement. Different terminologies, whatever you understand better, just understand that price, a bullish trend has to always have a healthy pullback so that it makes the market efficient and balances the inefficiency. Okay, a bullish trend always has what we call a healthy pullback. So it balances market inefficiency, fuels imbalances, and all of that. So we personally for me, I will be looking to see how I can get a confirmation that will pull price down to this zone or to this extreme. I would prefer this extreme. But if I get a good confirmation here, I will get in on the buy. All right. So this is my daily bias on DXY. We are still bullish, but right now I think market wants to initiate. I think market wants to initiate a retracement, which will make us go down to a lower time frame. Let's see what the 4 hours is having. Some of these zones I've marked them. Bear with me. Now this is that daily zone. The closest daily zone we have. This is it. That is this one here. That is this first zone here. This daily zone here. I made it visible on the 4 hours. So when we come to the 4 hours, we can see it here. Because if we sell, this is where we are targeting. This will be our take profit level. If we want to sell, this will be our take profit level. So on the 4 hours, you see that the immediate price action on 4 hours is actually still bearish. Created this low, putting this high, created this low, putting this high. This high is our inducement. Remember what I talked about a valid zone, characteristics of a valid zone. Characteristics of a valid zone is number one, a valid zone break structure. This is on the 4 hours. So we have a very sweet break of structure. Sorry, there's a break of structure. make it break of structure. Break of structure. Now we have a break of structure. We have our inducement. Have our inducement all the way from here all the way to here. All this all these things are liquidity. So I've held the liquidity. And when you mark out your trading range from this high to this low that price created, you could see that the zone is an extreme premium, which is how I like it. It's an extreme premium that shows that okay, if this zone actually gives a confirmation, it's gonna sell. So it's an extreme premium. It meets all our criteria. All right. Does it have inefficiency? Yes, it has inefficiency here. So it meets all our criteria. And right now you can see that market has actually mitigated that zone. Market has actually done what? Mitigated the zone. So that zone has been mitigated. Let me see. That zone has been mitigated. And what we have now is so this is our liquidity here. It's it's plus this one and all of that, but I just want it to be straight. So let's please, that should only appear on the 4 hours. I don't want it to litter this setup on the 4 hours only. That should appear only on the 4 hours as well as this one. My structure, my frame, my bias, I keep it just on the time frame I need to see it. I don't want it to be on every time frame, except I need to see it on that time frame. So I don't want it on every time frame. This is only on the 4 hours. This is only oh, this is an hourly zone. That zone is a 1 hour zone. So on the 4 hours, this is our zone, and we are having a reaction from that zone. If the reaction should hold, we should have something like this on the 4 hours. We should have something like this that takes price back to this zone. The stop loss realistically is actually supposed to be above the structure high, which is this high. You just put your stop loss there and allow it to run to this low, which is 4.84 breaks to reward. Okay, that should be on the 4 hours. On the 4 hours, not on the 1 hour. So I'm going to put this back on the daily. I'm going to put this back on the daily and remove it on the 4 hours. So we have a sell setup like this. So if we have a sell setup like this, that means any negative correlated pair we should be able to give you a buy setup like this. Any negative correlated pair, all those XXX USD pairs, you should be able to frame a buy setup like this. Not exactly, but this should be your core bias. All right, this should be your core bias. So on the 4 hours, if you now further refine it on the 1 hour, this is we are looking to sell, but on the 1 hour, we are already reacting from a buy zone. So you must know what you're looking at. We're already reacting from a buy zone. That means this zone can as well fail. If this zone fails, it will use this zone as liquidity, mitigate. It will use this high as liquidity, which was our stop loss for our trade, mitigate this zone here, which is very extreme, and then sell from there. On the 4 hour, that zone is somewhere around here. I think I marked it. Let me go back to the 1 hour. This zone, if I should put it on the 4 hour, if I should put that zone on the 4 hour, somewhere around here is extreme. So if this zone fails, this zone will be used as inducement, and we're going to sell from this zone. All right, we're going to sell from somewhere here. If this zone fails, that is why you only trade with confirmation. So 4 hour is opposing this trade here. 4 hour supply zone is why this trade is stalling in this place. All right, because this is a trade coming from the 1 hour demand, but the 4 hour supply is opposing it. Okay, is opposing it, and 4 hour is stronger than 1 hour. So on 1 hour, we have this. We are trying to see if we can buy to this zone before we sell. But if 1 hour doesn't hold, that means 1 hour will fail somewhere around here and start selling. Because if you look there, there's also a 1 hour zone. There's also a 1 hour zone, though that this one is the extreme. There's actually a 1 hour zone somewhere around here. If you look carefully, you'll see it. And that zone is also a valid zone. And that is also where price is reacting from. So marking that zone is not random. This zone is also a valid zone. Do you understand? On 1 hour, it's also a valid zone. So this zone was the zone that took the structure high. Use all of this as liquidity. Has enough inefficiency. Is at the premium of the range. So this zone actually meets our criteria to push price down. We have it on the 1 hour. We have it on the 4 hours. All right. I just want this to be on the 1 hour. So we have it on the 1 hour. We have it on the 4 hours, and you can now see how it works. So current bias for DXY, if this zone holds, the current bias is what? Is bearish. Current bias is what? Is bearish. And if current bias for DXY is bearish, that means the correlating pairs you want to trade against the DXY should be bullish because it's negatively correlated. Okay, so this is how you frame your top-down analysis using the demand and supply trading model. I hope you were able to get something. I don't want to make this video too lengthy. DXY, the dollar index, is a very important asset in market analysis because it gives you a view into what correlating pairs will do for the week. All correlating pairs, all negatively correlating pairs, even the positively correlating pairs, like for instance, UJ, that is USDJPY, I think is positively correlated to the DXY. All right. So always start your analysis with the dollar index. Once you know what the dollar index is doing, the negatively correlating pairs, you should be expecting the opposite on the negatively correlating pairs, and then you should be expecting the same thing on the positively correlated pairs. I hope this somehow makes sense. I've told you why I start my analysis from the daily, not because I don't want to go to the weekly, but intraday trading, at the end of the day, my new analysis starts from the daily. Okay, it's only at weekends that I start my analysis from the weekly. And at the end of the month, if I want to analyze, do a thorough top-down analysis for what will guide me through the new month, I start my analysis from the monthly. It's not a time frame I always visit to do top-down analysis. No, I already know what is there. So the every day that ends, I start from the daily. Every day that ends, I start from the daily. I frame the story. There's a storyline. Where's price coming from? Where's price heading to? Why will price have to come down here? And why will price have to do this, do that? So if you can frame all of this, it becomes a lot more easier for you. All right. So I hope you were able to pick something. You have a question, do ask, and I will do my best to address it. Do have a lovely trading week ahead. Wishing you a profitable week ahead. And bye bye for now. I remain yours truly, Big Blue FX.